Good morning, friends. As usual, Saturday morning starts with Mehta and Mehta. After your breakfast, it's a knowledge breakfast for you every Saturday, and we are happy as the Saturday passes. Our more and more participation increase, active participation. People are appreciating our format of active participation and actual discussion. We had a series, we have started the series of related party transactions. One session was over. Sorry, I was not able to attend last time because of last minute emergency. And today, interestingly, we have taken the topic which is very relevant for our related party transaction, but which is majority time not taken care. And today's topic is Decodification of Accounting Standard 18 and Indian Accounting Standard 24, ordinary course of business, arm's length, office, place of profit, etc. These are most complicated, but always we have questions and confusions and all that. So today our session is to answer all that, your questions, queries. And today we have with us our panelist, Mr. Bala, as usual, you know that, and Mr. Nikhil Patel, the senior partner of MS Kapoor and Parekh Associates and SS Kapoor and Company. Welcome, Nikhil. And of course,
thank you.
We have with us our own Sudhakar, and also we have our presenter, Ms. Kinjal Mehta, Senior Associate Mehta&Mehta. Let me introduce Nikhil. Nikhil is I must say, my friend, MOCP batchmate. So we share a long relation, and he is very active participant of our, this webinar. Thanks, Nikhil, for your time. Nikhil is a BCom, LLB, and member of CS Institute. He is practicing since 1985, long age here. Proprietor of Nikhil Patel and Associates and partner in Kapoor and Parekh Associates and SS Kapoor and Company Chartered Accountant. Specialized area of accounting, auditing, direct tax, merger, financial management, regulatory framework, audit of listed, unlisted company, LLP, farm, trust, involved in merger of various listed company. Experience in audit, taxation, corporate advisories of company having 1 billion or to 150 billion. Great. He is a member of Bombay Chartered Accountants Society, Chamber of Income Tax Consultant, International Fiscal Association, and is associated with charitable trust and social organization of Dipti Parivar, Aim for Seva, Sri Vishweshwar Trust, member of Accounting Auditing Committee of Bombay Chartered Accountants Society. So friends, here, Nikhil Patel. Welcome, Nikhil, to our webinar. Thanks for your time. As usual, I'll request Sudhakar, then Mr. Bala, to have few words for one minute on the topic. Then Kinjal, you can start your presentation. Over to Sudhakar. Thank you.
Thank you, Dipti. Thank you very much, and good morning, friends. And as Dipti has mentioned, we are having the second webinar in the series of RPT. In fact, several times whenever I address the students, I used to say the importance of Section 2. Normally, if you ask any company secretary, except the exam time as a student, once he becomes the professional, he thinks that there is no need to read Section 2 at all. Section 2 primarily of any law, it confines about comprises of definitions. So to understand any law, to understand the nuances of any law, understanding the definitions are the most important thing, which I realized a bit late in my life, corporate life rather. Especially after joining the Reliance, I understood what is the importance of the definitions. Similarly, in case of related party transactions, there is some key terminology is there which we are going to discuss today. Normally, if you attend any presentation, the amount of time what we spent on these key terminology is very, very less. Virtually, it is negligible. But tomorrow, when the regulator comes for any kind of inspection, based on this ordinary course of business and arm's length, if we take the exemption of Section 188 and not complying with that section, and the regulator is not agreeing with your way of understanding and of the ordinary course of business and arm's length, if you are not able to convince him, obviously the non-compliance of Section 188 consequences will be attracted. At the same point of time, it is also equally important to understand the importance of the accounting standards AS-18 and IndAS-24, because for listed companies, whoever is the related party under the accounting standards, they become related parties to the company. Apart from that thing, though, even for the unlisted companies also, understanding accounting standards are very important because the disclosures are to be given in the financial statements. Again, to the best of my understanding, the amount of importance what our fraternity gives to the accounting standards is virtually negligible. We may read only what is important, or maybe about 10 to 15% of that. But we should have a fair amount of an understanding, because we should not leave it to our accounts colleagues as far as the disclosures are concerned, because most of the time the company secretaries think that disclosures in the financial statements is the responsibility of the finance and accounts colleagues. Actually, according to me, it is equally important for a company secretary, because you are the compliance officer of the company. So you need to ensure that the proper disclosures have been given. So in fact, that's why I requested Kinjal, who is a chartered accountant and company secretary, and he is the most upcoming professional in Mehta&Mehta. And I saw one clipping of Kinjal about 2 weeks before, and a person who is experienced. In fact, I always say that a homemaker, if she wants to know whether the rice is boiled or not, she don't need to see each and every grain. The top 1 or 2 grains, if she feels it, she knows whether the rice is boiled or not. Same is the case. I'm most convinced that as far as Kinjal is concerned, the clipping, when I saw that, immediately what comes to my mind is, let me request her to make this presentation on accounting standards, which immediately she has accepted. And to my knowledge, if I'm not wrong, might be this is the first and budding what's called maiden presentation of Kinjal for this kind of a forum. If Kinjal, if I'm wrong, please correct me. And good luck to you. Before you start your presentation, hi Valari, good morning. I request Bala to, take over the baton and then conduct the proceedings further. Thank you.
Good morning to all of you. I have a great pleasure in welcoming you all for today's morning session on my own behalf and also on behalf of Mehta&Mehta. We have actually 3 great emissaries with us. Mr. Nikhil Patel, who has been in the practice for so long, who knows very much about the related party transaction from the accounting point of view, accounting standards of view, and also company secretary point of view. And Mr. Sudhakar, I don't have any words to say because he has been delivering across the country related party transaction, various lectures, sharing his experience, etc., and other things and all. We have Valerie Gupta, who is there very much in the practice of one of the listed companies. But as far as this topic is concerned, you all may be aware, even in the SEBI LODR regulations, there is a policy is required to be formulated related party transaction policy, which need to be put on the website. That is one of the requirements under the SEBI LODR regulation itself, which is actually there. Apart from that, the ComapniesAct, there are a lot of provisions which Kinjal is actually going to take to us. But there are 2 aspects when we look into the related party transaction. One is related party transaction, which are actually there in the financial, which is actually looked into by the statutory auditors from the point of accounting standard, Schedule 3 requirement, and whatever the notes to accounts, etc., and other thing and all, he is going to look after, he is going to roll up on this. Not. But company secretary, our role, as we being a signatory to the annual financial statements, we are responsible for the compliances as per the ComapniesAct is concerned, as well as the SEBI LODR is concerned. Because there are not many things which are required to be disclosed on a related party transaction in the notes accounts, even in the board of directors report, etc., and other things and all, which we are concerned. Here, what is required, we have to understand from prima facie, what are the things which are required to be disclosed. Because many people think there are routine transactions need not be disclosed. Many people think there is no transaction is there with the related party, not required to be disclosed in the related party, etc., which is not the case. Because first and foremost, the thing is, all the related parties information need to be disclosed at all, whether you have the transaction, you don't have the transaction at all. When you talk the related party, as per the entity is concerned, now they included what you call ultimate holding company. So ultimate holding company, immediate holding company of the parent company, immediate holding company, subsidiary company, associate company, fellow subsidiary company, all the details required declaration. Plus the KMPs that require declaration. Then once that comes into transaction. Because having a transaction with a related party per se is permitted definitely. But the only thing is, as Sudhakar puts it, whether the transaction is actually entered in the arm's length or it has got the special consideration, that is the question arises there. So any transaction which are entered related party, even routine transaction like, we may be having the dividend payout, we will be exporting our goods to our parent company, we will be importing, exporting raw material to our parent company, subsidiary company, associate company. All these things are all actually related party transactions which has to find place in the financial statements. So as a company secretary, we need to ensure all the required details are actually sitting in the financial statement. Although from the accounting point of view, you will look into the various transactions, certify, etc. and other things. So these are some of the nitty-gritties which are actually there in this. I think today Kinjal is going to take both the subjects. One is what is related to accounting standards as such. And second thing is what are the various disclosures which are actually required to be. And she will be also discussing at length what are related to party transaction. There are certain exemption transaction, etc. She will actually take us through. I think Nikhil and Sudhakar, they will definitely add their practical experiences in this relevant development which have taken place, which are definitely of the great addition to all of our knowledge. Thanks a lot. With this, I request Nikhil to say a few words on this before we start the presentation. Over to Nikhil, please.
Yeah, thanks, Bala. As you rightly said, that something is not material, etc. So we need not disclose the related party transaction is incorrect. Now, being a company secretary, we are privy to certain transactions which auditor may not be aware. Just to give an example, if there is a, let's say, Tata Power company. Now, there are independent directors, so directors are related party. Now, obviously, he also may be having a connection from Tata Power only. So he might have given a deposits. So that deposit also is outstanding at the end of the year. So that falls under RPT, and those small things also need to be reported. Now, as far as accounting standard is concerned, from Companies Act point of view, whether you need approval, etc., is covered by the Companies Act. But as far as AS-18 and IndAS-24 concerned, only disclosure is there. You need, assuming it is an arm's length, you don't need approval from the shareholders or directors or the committee, audit committee, etc. But disclosure has to happen. Now, disclosure doesn't mean it's not at arm's length or it is at arm's length. That's all I have to say. So from accounting standard point of view, disclosure, etc. is important. Rest of the compliance, etc., maybe because of LODR, maybe because of Companies Act, is over and above the disclosure and means compliance of accounting standard. That is all additional compliance to be done.
Okay, thank you, Nikhil. I think now, Kinjal, you can start your presentation, start sharing your screen.
Yes. All right. So today we're going to look at related party transactions from the IndAS or accounting standard perspective. Now, to understand why, the accounting, a specific accounting standard had to be made for related party transactions is because we need to understand how these kind of related party transactions have an impact on the presentation of profitability or the financial position of a company. So, for example, if a subsidiary is supplying goods to its parent, then it is possible that the subsidiary may be supplying the goods at cost. Now, if they say this kind of a transaction will definitely have an impact on the profitability of the subsidiary as well as the parent. So when the reader of the financial statement is actually looking at these financial statements, they must be aware of these kind of transactions that have taken place in order to understand the operations and the financial situation of the company. So we shall move to what this particular standard is. So basically IndAS-24, it is divided into two parts. One is basically identification of the related parties and transactions and disclosures of such related parties and transactions. So when you're, so by identification, we are identifying the related parties as well as the transactions, and specific exclusions in cases where it may seem like related parties, but it is explicitly excluded from the definition of related parties as per the standard. Then we also look at the disclosures, and in disclosures we have two types of disclosures. Basically, one disclosure, category 1 disclosure, where basically you may or may not have transactions with a particular related party, but a disclosure needs to be made about that related party. And the second one is basically when the disclosures are only to be made when there is a related party transaction with those parties. Again, you have specific exclusions for such kind of disclosure requirements. So we shall move on. So let me just start with the applicability of IndAS and where AS is applicable, where IndAS is applicable. So I'll just quickly run through this. So IndAS is now applicable for all listed companies or the companies that are in the process of listing in or outside of India. All other unlisted companies having net worth of more than 250 crores are required to follow IndAS. Then also the holding subsidiary, joint venture or associates of all these companies also need to adhere to IndAS. IndAS is now also applicable to NBFCs, but it is still not applicable to banks and insurance companies. It is also, one also needs to note that once IndAS is applicable, it shall continue to apply even if the company falls out of the applicability requirements of IndAS. Also, so it is given that LLP, sole proprietorship, partnership, and all such kind of organizations don't necessarily need to follow IndAS. They can go ahead with their accounting standards. So let's move on to identifying related party, or the concept of related party as per the accounting standard. Now, the accounting standard divides this kind of a relationship with two types. So one, a reporting entity, or the entity who is making the financials for which the disclosures are required, can have a relationship with an individual or a person, or a company or an entity. So when you're talking about a person and an individual, you're talking about an individual and his close family members. The accounting standard defines the relationship with a person being, who has control or joint control over the reporting entity, or who has significant influence over the reporting entity, or who is a member of the key management personnel of the reporting of the company, of the reporting entity, or the parent of the reporting entity. Okay, so I will just deep dive into as well as his close family members who may be expected to influence or be influenced by that person in the dealings with the entity. So the standard explicitly defines what do they mean by these close family members. So this includes that person's children, spouse or domestic partner, brother, sister, father, mother. Now, domestic partner and all, so this standard has been adopted by international IFRS. So these kind of concepts have also been adopted into our IndAS, which was not there earlier. Children of the person's spouse or domestic partner. So now this is a specific inclusion by this IndAS, which includes, the spouse who has children from previous marriages, or the domestic partner, their children also under, a related party of a person. It also includes dependents of the person, or the dependents of the person's spouse or the domestic partner. Now we look at the meaning of control that the standard basically defines. When you talk about control, we're talking about it is not necessarily always 50% or above stake that a particular person may have in a company that defines control. It also exists when the investor is exposed or has rights to variable returns from its involvement in the investee and has the ability to affect those returns through its power over investee. So so previously when control was limited to 50%, more than 50% stake in all this standard broadens, and tries to cover any other arrangements where control might exist, where the entity has power to affect the returns of and is exposed to the returns of another company. It also defines power. So what do you mean by power when you're talking about power, having power over another entity? So power refers to the existing rights, so not future rights, existing right that gives the entity its current ability to direct the relevant activities of the investee. So it is the existing power of the entity to direct the relevant activities. So when we're talking about relevant activities, we're talking about various types of financial transactions that are taking place in the company. Now moving on to joint control. So joint control it refers to contractually agreed sharing of control of an arrangement which exists only when decision about relevant activities require unanimous consent of parties sharing control. So this basically means that it is not necessary that if someone who has 75%, if there are two entities, one with 75% stake, another with 25% stake, but when there are decisions in the entity that can be only made when if and only if both the parties agree to a particular decision, regardless of the shareholding of both the entities. So that we refer to as joint control. It is usually, it arises in the form of specific agreements that are the parties have entered into. Now, what we mean by significant influence? So it is basically the power to participate in the financial and operating policy decisions of the investee, but it is not in control of those policies and decisions. So, for example, if you would have stake more than 20% up to 50%, is usually when one has this power. It is the standard does not limit, the significant influence to shareholdings as per shareholdings, but there may be some other way in which an entity participates in the financial operating policy decision, but is not in full control of whether these policies or decisions go through. So
Kinjal, just 1 minute. Now let me clarify here the previous slide, control. Yeah. Now control, as Kinjal has rightly said, that they have a right to do, and you need not exercise the right. Like what happens? Suppose holding company is holding at 60% in the subsidiary. Now, assuming there is a professional management and there is not a single director from the holding company is nominated on the subsidiary company, but they have a right to remove all the directors, add all the directors. So having that power itself is enough to establish that holding company has a control on the subsidiary. Now, they may or may not exercise. Now, if the company is running smoothly, assuming they have appointed the professional director, they are doing well, they may not interfere, yet control is there. So that is on that part. Now, when we come to the joint control, there is a very subtle difference between and how it affects the arrangement. Now, joint control, as it is rightly said, it's a joint decision by both. So sharing could be 99:1 or 50-50 or any ratio. However, decision is jointly. Even if I am holding 1% and Kinjal is holding 99%, when we decide any matter, we decide with the consent of both. That's the joint control. And the moment there is a joint control, there is a different way of accounting. Then you fall under AS-27. Now it's when I have to consolidate, I'll consolidate my 1% only. Kinjal will consolidate only 99% of the transaction. Now, assuming it is a private limited company where I hold 1% and Kinjal 99, and if it is not a joint control, then it's a subsidiary of Kinjal. Then as a 1% holder, I don't do any consolidation. But if it is a joint control, even with 1%, I have to do consolidation. So that's a difference between joint control and an influence. Now, standard says if you are holding 20%, you deem to have an influence unless you prove contrary. Now, that doesn't mean less than 20% may not have influence. Now, there could be VC's investment, 10%, 12%, 15%. Theoretical, let us assume it is less than 20%. But in the agreement, there is a clause, articles also that they will have a nominee director. The moment they have nominee director, then there is an influence on the company. So even if VC is holding 1%, it's a significance control and it will be an SOC. Okay, so that's just to clarify the matter. Yeah, Kinjal, take.
These three definitions are derived from IndAS 110, 11 and IndAS 28, correct?
Yes.
Yes, yes. This is from the accounting standard,
Yeah,
both AS
you're
as
right.
well as IndAS.
Okay.
You're right. You're right.
Yes, so the standard in itself doesn't define these definitions. It refers to other standards, that is IndAS 110, 27 and all, where these definitions have been put in place. Okay, then we also when we are looking at relationship with a person, we also look at the KMP of the reporting entity or the KMP of the parent of the reporting entity. So the standard also has its definition for its key managerial personnel. It is not as how it is not the same as in ComapniesAct, LODR, those places. The standard has its own. So key management person, as per the standard, are those people having authority and responsibility for planning, directing, and controlling the activities of the entity directly or indirectly. And this includes any director, whether executive or non-executive of that entity. So if you'll notice, this is more open-ended kind of a definition where, it's not kind of focus on the designation of the person. It's more substance over form. If the person is responsible for planning, directing and controlling the activities of the entity, then you call that a KMP, not necessarily a CFO, CS, etc. As specifically defined under the standard, it includes other people too, having the authority and responsibility for such activities. The standard also includes members of management committees. So these members, of various committees that are responsible for the planning, directing, and controlling the activities of the reporting entity are also included in the definition of key managerial personnel. Okay. Then moving on, when the standard refers to any kind of subsidiaries, any kind of associate or joint ventures, it automatically includes the subsidiaries of the joint venture going forward. Now you'll see the standard provides the definition of related party in the most exhaustive manner. Everything is clearly defined. It's not very, it's not an inclusive definition, but at the same time, the standard promotes substance over legal form when we're looking at various transactions when it comes to IndAS. So let's look at a few examples. So if when we're looking at relationship with an individual or a person, so if Mr. A holds 51% equity in share capital of A Limited, A Limited has no other form of share capital, then Mr. A controls A Limited and he's a related party. This is a very easy, straightforward example. of a related individual. Then let's look at the other one. Now, the wife of Mr. A, who holds 51% of equity shares of A Limited, also becomes, the related party of this A Limited company by the virtue of being a close family member of Mr. A Limited, who controls, A Limited. Now, looking at the third example, Mr. D is the director of A Limited. Now, since he is a KMP and he is responsible for the planning, directing of the activities of the company, he is a related party to A Limited. Now, in the next one, Mr. D is a director of H Limited. S Limited is a subsidiary of H Limited. Still, Mr. D is related to S Limited. Now, the definition includes KMPs of the parent companies also when we are looking at related parties, looking at the definition of related parties. So the directors of the parent company will also be a related party to the subsidiary of that particular company.
Yeah, Kinjal, just a minute. So if you are dissecting the relations, it is better that we divide the entities into two. One is a living entity, means living person.
Right.
And second is entity. Now, entities could be anything. It could be public limited, private limited, listed company, non-listed, LLP, trust, any form.
Yes.
So once you have identified person is a living, then it will be easy related to the promoter, whether he is a director of the holding company, he is a director in the subsidiary company. So if it meets the criteria, he is a related party vis-a-vis to the reporting entity. And then if it is an entity, then you have to look into whether it is a subsidiary, fellow subsidiaries, holding company, ultimate holding, etc., or a joint venture, subsidiaries of some holding company. So that will be very easy for you to classify the company, means entity and individual, being a related or unrelated.
Yes. So right now we're just looking at individuals at the moment when we're looking at related parties.
Nikhil, there is somebody has put a question. Whether an entity controlled by the reporting entity, not a subsidiary company or an associate company, considered as its related party.
Sorry, can you come back again?
Whether an entity controlled by the reporting entity, not being a subsidiary or associate, whether they are considered as related party.
Okay, so as of now, we have only covered individuals or living entities when we're looking at the related.
I'll answer it as soon as Kinjal comes to entity part.
Okay.
Yeah, so now we'll just move on to different entities that are related parties. So here I'll just, so as you will see over here, when we are looking at relationship with a person and a relationship with another entity. Now we're looking at a relationship with another entity. There are list of circumstances and situations that the standard has defined where the standard explicitly says that this is a related party and you have to make disclosures about that. So let's have a look at these situations. So the first one, if the entity and the reporting entity are members of the same group. So when we're saying the other party and the reporting entity of the in a particular transaction are of the same group, that is parents, subsidiaries, and fellow subsidiaries. So over here, H Limited is the holding company of SA Limited and SB Limited. So we can say that H Limited, SA Limited, and SB Limited, being the members of the same group, are related parties. Then let's move on to the next one. Another situation. Now, one entity is an associate or joint venture of the other entity, or an associate or joint venture of a group of which the other entity is a member. So, in simpler words, any joint ventures or associate companies also of a particular group are included in this definition. So let's look at an example to make it easier. So AS Limited is an associate of S Limited. Now S Limited is a subsidiary of H Limited. And SH Limited is another subsidiary of H Limited. So S Limited and SH Limited are fellow subsidiaries, and AS Limited is an associate of S Limited. Now the standard says in this scenario, AS Limited and SH Limited are related parties. Since AS Limited is an associate of a member of the group company of S Limited, by that virtue, it is also related to the fellow subsidiary of S Limited. We'll move on to another.
So Kinjal, in short, what happens if you are part of the group, automatically you become related to all the group entities?
Yes.
Sort and substance.
Yes.
Sorry to ask one question. Under IndAS-24, co-ventures and co-associates are related, but under AS-18 it is not related, correct?
Yes.
Is my understanding right?
Yes, correct.
Yeah.
That's one of the key difference between the relative and this. Okay.
Yes, yes.
I think now here, Balaji, you were saying, no, somebody has asked about the control.
Yeah.
Now control, let's say by an agreement. If somebody has a control saying that I will have a right to appoint majority directors, then it is a subsidiary and control exists, even though he may not be holding a single shares in the company. So we have to see what kind of control it is. If it is a full control, then subsidiary. If it is less than influence, then associate. So because of that also, that party can become a related party.
Yeah, you're right. The moment control actually comes into the picture, what you call as Kinjal has actually put it, the one party has got a ability to control the other party. Then automatically it becomes a related party here. Need not necessarily they have the share, etc. and other things and all.
Absolutely.
As you rightly say here, the question is from vague. Without knowing the details, we will not be able to answer full. But the control element is there, then it creates a related party.
Correct. But control agreement has to be by way of a legal format. Some agreement should be there.
Yeah.
Just because somebody is my friend and he listens to me and he does what I tell him,
yeah,
no control, no related party. But if there is a formal agreement like VC holding only 5%, but they says I have a right to appoint majority director, then that becomes a subsidiary. Now being a subsidiary, assuming VC also is a corporate entity, they will aggregate full 100% and they will show 95% and non-controlling interest, which is little weird situation. Normally, when majority means at least 51% should be my part and maximum 49% is others. But technically, because I have a right to control the board of directors, I may show 99% as non-controlling entities share and only 1% mine.
There is somebody is asking a question whether the term director in definition KMB bracket IndAS includes independent director.
Yes.
Yes. So if you give remuneration to director, it is a related party.
Yeah, just now only I think he suggested in the opening paragraph itself, even the independent director is holding some sort of a deposit with a power supply company that need to be disclosed. So naturally, if the transaction is there, definitely is a related party, whether it is an independent director or ordinary director. Yeah.
Should I move on?
Yeah. Yes.
Okay. Let's look at another situation. Now, both entities are joint ventures of the same third party. So over here, H Limited has a joint venture with A Limited called JHA Limited, and also has a joint venture with B Limited called JHB Limited. Now, in this scenario, JHA Limited and JHB Limited will be related parties. Okay, let's move on to another relationship situation. Now over here, one entity is a joint venture of a third entity, and the other entity is an associate of the third entity. Okay, so let's look at it with the help of an example. Now JH Limited is the joint venture of H Limited, while AH Limited is an associate of H Limited. Now the standard says that JH Limited and AH Limited will be related parties. The joint venture and the associate of the of one third party will be related parties. Okay. Next one, the entity is a post-employment benefit plan for benefit of employees of either the reporting entity or an entity related to the reporting entity. If the reporting entity is itself such a plan, the sponsoring employers are also related. So there may be companies that put in place special funds for post-benefit plans for their employees. In such case, the entity who's the sponsor of such a plan of such a fund will also be related party, and if the reporting entity, the fund is itself reporting entity, then the sponsor company will be related. And if the post-employment benefit plan is for the benefit of some other group company, then such company will also be related party. Okay, then another situation, the entity is controlled or jointly controlled by a person identified previously. So over here, now if a person controls two entities, then those two entities will be related parties. So let's look at an example. Mr. A controls A Limited, which is the reporting entity. He also controls B Limited. Now A and B Limited will be related parties, will be related to each other. Another situation, a person identified previously, so when the definition of person that we have referred to earlier, has significant influence over the entity or is a member of the KMP of the entity or of the parent entity. Okay, so let's look at an example for this. Mr. A controls A Limited, which is the reporting entity. He is also non-executive director in B Limited, again having significant influence. Then A and B Limited are related parties. Okay, now another scenario. The entity or any member of a group of which it is part, so any group entity, provides KMP services to the reporting entity or the parent of the reporting entity. So there are times when certain company is providing KMP services to other group companies in the group. At that time, the reporting entity or the parent of the reporting entity become related. So let's look at an example. A Limited is a parent company with 3 subsidiaries: B Limited, C Limited, D Limited. It also has an associate company called E Limited, which has a subsidiary called F Limited. Now, F Limited is providing KMP services to A Limited. In this scenario, A, B, C, D, and E Limited will become related parties.
We have somebody has raised the hand. No, Jignesh Bhai, you wanted to ask some question? Jignesh Bhai. Probably is not there. Yeah. Continue. Yeah, Kinjal, continue. Yeah.
So,
Hi. Yeah, so we recognize presence of Pramod Bhai, our past Central Council member in the of the Western region. Thank you, Pramod Bhai, the youngest
Thank you.
participant
And
in
my
our
congratulations to you and
presentations. Yeah,
congratulations to you and Madam for very nice webinars you have been doing every week, and we are proud of you.
thank you, sir. Thank you. Your blessings. Yeah, Jignesh Bhai, you are around. You can ask the question, Jignesh Bhai.
Hello.
Yes, please,
Hello.
go ahead, go ahead.
Yeah, sorry, there was some issue with the mic.
Okay.
So I have a question, whether the control includes direct and indirect control also, or whether we should construe it as a direct control only in the definition of.
Yeah,
Yeah.
Nikhil Bhai would like to answer this.
Yeah, controls means control, direct or indirect. For example, A Limited is controlled A Limited is, let's say, controlled by B Limited, and B Limited is controlled by C Limited, which is ultimate holding company. Still
Okay.
that control exists.
Okay, so it will include both direct and indirect.
Yeah,
Thanks, sir. Yeah. Yeah.
Similarly, in various examples, as Kinjal has covered, A Limited is holding company, then B, C, D, like in this example, 3 subsidiaries. So all 3 subsidiaries will be related to each other because they have a commonly controlled by somebody else. Now, suppose A Limited has further H Limited, which or UL Limited, which UHL, let's say ultimate holding company. Then ultimate holding company automatically will be related with B, C, and D over and above A Limited. So that is the indirect control.
Okay, sir. Thanks a lot.
So, Nikhil Bhai, see, these control definitions is, everywhere, in many of the places, Sudhakar ji, if you're there, just wanted to ask you. So, if I'm a company secretary and probably I have so many associates, I have so many subsidiaries also, and so. So when you take those definitions, all put together, so you have a Companies Act definitions, you have a IndAS, definition of a control. So somewhere, you say that, look, you have not followed this definition. So from the perspective as an company secretary and as a statutory auditors, now what would you take? You will limit yourself with respect to IndAS only and the Companies Act only, both put together. Yeah.
No, I mean, for example, if I am the auditor, we have to comply with all the provisions. So there are little different provisions under the Companies Act, little more under the LODR, and accounting standard required separately. Now, if I am falling under IndAS, then I have to follow IndAS related party transaction. If I am in AS, then I will have to follow that.
Okay.
So we'll have to follow all.
Okay.
So
Yeah.
I believe
Sudhakar, you wanted to say something?
Yeah. See, the only thing is, control is defined in takeover regulations, control is defined in listing regulations, in accounting standards, Companies Act. So wherever it is defined for that particular purpose only, for the limited purpose of that particular law or the regulation or the standards. Suppose in a particular thing, if it is not defined, then what will happen is you have to go to the nearest whatever is available, and then you have to draw an inference from that particular definition, and you have to do it. Say, for example, SEBI takeover regulations. If it is not defined, but it is defined in the listing regulations, then you can draw an inference from listing regulation, not from the Companies Act. As far as the accounting standards are concerned, that definition which is given in the accounting standards is limited to the accounting standards only. That means only for the purpose of disclosure, not beyond that. Yes, Kinjal, you are saying something.
Yeah, so I think when we're looking at related parties with respect to Companies Act, LODR, it's more to do with any kind of approvals required from the various committees and things like that. But when we are looking at IndAS, when we are defining related parties under IndAS, it is very limited to the kind of disclosure that is to be made in the financial statement. And it is there's a separate disclosure that goes into the financial statement for this particular standard, where this standard is basically trying to tell you what is to be included and how it is to be included.
I think, yeah. So the company secretary is always in a dilemma. You have to comply under the Companies Act, then this, of course. But if it is from the perspective of the takeover, definitely one has to look into those regulations also. Yeah. See, now we are getting a lot of questions on the chat box. The directors, executive directors, independent directors, and yeah. So somewhere, I don't know. I mean, somewhere if you get, somewhere, caught, where your any of those, independent directors are directly, indirectly are associated or connected, then probably you get into this trap, I mean, of this definition. So, yeah.
See, Atul, as Nikhil has puts it very clearly, what is the requirement? Requirement is if there is a related party, you have to disclose who are the related party.
Okay.
As he rightly put it, as per the entity and as per the individual concern, or the individual that be director, KMP, etc. of the company. And when it's come to the individual entity, it is including the ultimate holding company, parent of the immediate holding company, subsidiary company, associate company, fellow subsidiary company, everything. That is, as per the company secretary is concerned, we are actually concerned, A, ComapniesAct compliances in respect of all the companies, LODR regulation compliances in respect of listed companies. What is called for in the financial is actually a disclosure. Rest of the things, it is taken care of the statutory auditor. We have to only see the necessary disclosure or disclose whether there is any related party transactions or not there. Coming to arm's length transactions and other things, etc., we have yet another session where we are going to specifically discuss the approval mechanism, etc., and other things. We are specifically having one more session where we'll discuss it. In fact, in this chat box also, I see there are a lot of questions which have come related to approvals, which I am not going to take in this session because we have a separate session for the approval. During the session, we will deal with those things. Here we are talking per se, a related party transactions, exclusions, and a disclosure related arising out of the related party transaction. That is it. So we have to ensure the compliances which are applicable under the Companies Act, LODR regulation with a reference to financial statement, the required disclosure are near to or not.
Yeah, I fully agree with Bala, what Bala has said. For example, what right now we are discussing is related party from the point of view of accounting standards, either AS or IndAS. Now, that little example which I shared, that if I am a director of the Tata Power and I have a Tata Power's connection earlier before I became a director, so I must be having some deposits with him. Now, under AS or IndAS, it becomes as a director, I am related party. Now, earlier I have become a director subsequently, but I am having some deposits. Now, transactions are arm's length. Tata Power is not giving me power at concession. What earlier they are charging or what they are charging, everybody getting charged to me. So that deposit being now becoming related party transactions, as per standard, I have to disclose my deposit of 5,000 is outstanding. Just as an example. So what AS says, you do disclosure. Now, obviously, no Companies Act requirement is involved. You don't need approval of the audit committee or board of director for taking the deposits. Everything is at arm's length. So that is a separate part of compliance. Right now, what we talk under AS, if it is related party, then these are the disclosure requirement. First of all, you disclose all the related parties, whatever, irrespective of transaction with the related party or not. That's what Kinjal has correctly brought out. If you have a transaction, then disclose the transactions. And if any is outstanding out of the transaction, that needs to be disclosed. Simple. These three disclosures are there. Just to clarify the matter.
There is one question which is usually asked by many people. Again, it has actually come up, saying that, as a compliance officer, the CS to comply with the various applicable laws, including IndAS, SEBI, Companies Act, FEMA, etc., and all this thing. In case of the controversy between these laws, the CS has to go by which law, which is actually there, which is supreme. This question is actually unwanted questions, because the thing is, if you are under the Companies Act, you have to comply with all the Companies Act. If you have gone to the listing agreement, it is a separate agreement entered between the stock exchanges with the company, which is actually monitored by the SEBI. You have to comply with that. Out of that, which is the stringent regulation, you have to comply with it. You cannot say, I will comply this, I will not comply this. You cannot say there is no argument in this.
Absolutely right.
And second thing is, as far as the IndAS is concerned, IndAS is also part of the Companies Act only.
Yes, absolutely. It draws it right. That's why I am making it very clear. Like suppose in the applicability of IndAS, subsidiaries, associates, etc., all liable for IndAS. Now, a small difference between corporate and non-corporate entity. Now,
And
if you are a private limited company and if you are an associate of a holding company which is liable for IndAS, so because of Companies Act, even an associate will be liable for IndAS. and it is a contagious disease. Once you are IndAS, forever throughout your life, you are IndAS. Suppose tomorrow holding company sells the stake and you ceases to be the associate, still you will have to follow IndAS till your life. But assuming you are LLP and the holding company, which is a listed, so IndAS is applicable to holding company. Now holding company is, let's say, holding 25% in LLP. So irrespective of LLP, it becomes the associate of the holding company. So consolidation has to be there. But LLP is governed by the LLP Act. Now LLP, this IndAS is prescribed under the Companies Act, not under the LLP Act or Partnership Act or a Trust Act or any such other entities. So for their own purpose, they can continue to follow the AS. However, for the purpose of consolidation, they have to convert AS into IndAS, and separate audit report normally is drawn for that, and then it gets consolidated.
So, sir, I just want a clarification. Hello.
Yeah, Jignesh.
Yes, please. Yes,
Yeah,
please, go ahead.
yeah. Sir, so if I am drawing a related party list, okay, so as per the listing agreement, it includes the parties under the applicable accounting standards. So when I say, so as far as IndAS is concerned, IndAS is very vast. From India's perspective, in the financials, I need to only disclose who are the related transactions having with the related parties. But as far as listing agreement is concerned, if I'm drawing a list of the related parties, it will include the parties under the IndAS. And accordingly, I have to comply with the listing requirement also as far as related party transactions are there. Correct, sir, or any other view?
I think AS, I'll just check about IndAS, but in AS also disclosure part is very clear. You have to disclose all the related parties, whether you have a transaction or you don't have a transaction.
Yeah, all the related parties are to be disclosed actually. As far as the financial statements are concerned, you have to give the list of related parties, whether the transaction is there or not there.
Not.
And you have to disclose the relationship also.
Yeah, so Jignesh, this answers your question. See, disclosure is in two parts. One is related party, that is irrespective of transaction, as Sudhakar ji said, has to be given. That is required by AS IndAS.
Right.
But and you also have to second limbo of disclosure is transaction with the related party. So if you have no transactions, you don't have to disclose. So let's say I have 50 related party, out of which I have transaction only with two parties, then I'll disclose only two parties. Transaction.
Right.
In the list, I will have a list of full 50 parties.
Right.
But there is a further disclosure requirement out of two parties. If I have some outstanding, even that I have to disclose. Now, sometimes it can happen that disclosure is my opening balance continues to be the closing balance. For example, in the previous year, I have given a loan. So let's say in financial year 21-22, I have disclosed a transaction loan given to subsidiary 1 crore as a transaction. Further disclosure will come. Outstanding also is 1 crore. Now come to 22-23, I have no transaction, but outstanding is there. So that outstanding disclosure will continue as a 1 crore.
Right, sir. But then I have to, so this relates to the IndAS disclosure. But I have to comply with
But because during the year you are not given any loan, there is no company law compliance needed.
No, Nikhil ji, that his question is slightly different. What he's asking is, see, Jignesh, there are two aspects are there. As far as the accounting standards are concerned, one aspect is of disclosures.
Right,
in case of unlisted companies, as far as the accounting standards are concerned, you have to confine it only for the purpose of disclosures, not for the purpose of compliances. Whereas in case of listed companies, because the related parties under the accounting standards becomes related parties as per as the listing regulations are concerned, you have to ensure the disclosures as well as the compliances also. Regulation 23, whatever the compliances are there, those compliances are also to be ensured.
Yeah,
yes,
that is what I am actually coming to, Sudhakar. What is Jignesh is asking? As per the listing agreement is concerned, disclosure is already there. But coming to the transaction entered with a related party, whether it is an arm's length transaction, not in the arm's length transaction, whether necessary approval will be required, whether it will fall in the omnibus approval or not, whatever the things are there, those compliances he has to meet separately according to the LODR regulation. Is that correct, Jignesh?
Right, sir. Right. Absolutely right.
Yeah. So Jignesh, as far as AS is concerned, AS doesn't tell you take the approval of the board, etc. Yeah. Financial statement you disclose. Now, additionally, either the Companies Act listing agreement requires approval that has to be complied with. That is over and above Yes.
That is his question. That is his question.
Right, right.
And one more thing is there. The director responsibility statement, Mr. Sudhakar also mentioned it last seminar also. They have to categorically say they have to comply with all the regulations under the Companies Act, Schedule 3, and also the accounting standards.
Okay,
Yeah,
sir,
yeah.
noted.
Yeah.
Yeah.
And
So-
here, Jignesh, what is very important, being company secretary, you are signatory to the financial statement. And under the Companies Act, management is supposed to prepare financial statement within the framework of accounting standards and applicable law. So which will include requirement of Companies Act, Schedule 3. There could be certain disclosure which emanates if you are a listed company, stock exchange has made certain disclosure. So even though it is not there in Schedule 3, not in accounting standard, even that needs to be disclosed. So within the overall framework, whatever disclosure, etc., is required, primary responsibilities of the management. Now, as a company secretary, you are signatory, you are part of accounts preparator or financial statement preparator. What is here, according to me, I have been on the other side as always an auditor. But sometimes such small transactions, auditor may not be aware because it may get debited directly to some expenses. It's difficult to find out. So as a company secretary, when you know that this director, that's what I gave example, so and so has become a director and he is having a deposit. Now, auditor may or may not be know, but if company secretary not, he should bring out. No, this is a related party, let us discuss. That's the only importance.
In fact, I have seen in some
I think Bala, I think we have completely hijacked Kinjal's presentation.
Yeah, now
Kinjal, in all fairness, we should allow her to make the presentation further.
Yeah, this will take it up in
next,
question
I
answer.
think next for 10 slides, we should not entertain any questions, because otherwise it is already 1 hour is over. I don't think she is even half the way. Let her make the presentation,
Mr.
because otherwise
Sudhakar,
she will lose the continuity, in fact.
But the uniqueness about this program, it should be more interactive rather than
No, I appreciate.
just
But only my concern is that poor girl, she is making a maiden presentation and we are hijacking that virtually. She might be thinking, what the hell is going on? So we should not give her that impression. Let her make the presentation first. After some time, again, we will intervene.
Yeah.
Thanks, sir.
These disclosure points are discussed later in the presentation. I'll just come to that.
Okay, go ahead.
Okay, now the second part we look at is identifying related party transactions. So this is an inclusive definition. Basically, the standard gives examples of such kind of transactions that can be entered into with a related party. It actually defines related party transaction as a transfer of resources, services, or obligations between the reporting entity and a related party, regardless of whether a price is charged or not. So there may be a compensation, there may not be a compensation. It may be at arm's length, it may not be at arm's length. The standard is not concerned with any of that. If it is with a related party that we have discussed, the definition of which we have discussed earlier, and if the reporting entity is entering into a transaction with such a related party, then a disclosure needs to be made. And the standard just gives, examples of such kind of transactions. So purchases of goods, properties, assets, services, leases, transfers of research and development, transfers under license agreement, transfers under finance agreement, loans, equity distribution, provision of guarantee, collateral, commitments to do something, not do something, executory contracts, settlement of liabilities on behalf of another entity or related party, management contracts, including deputation of employees, etc. So let's move on to specific exclusions from the definition of related parties. So that the standard actually excludes these particular scenarios when referring to related parties. So let's just look at them one by one. Okay, for first scenario, two entities are not related parties simply because they have a director or other member of KMP in common, or because a member of KMP of one entity has significant influence over the other. So, a KMP, if a KMP is, a KMP in Tata Sons as well as, Reliance Industries Limited, then, one can't just simply say that, RIL and Tata Sons are related parties just because, they have one KMP in common. We look at another example. So we look at an example. So Mr. A is a director in X Limited. He's also a director in Y Limited. There are no other interests in either of the companies or between these two companies. And there are no other transactions between these two entities. Then X Limited and Y Limited are not related parties. However, let's tweak this example a little bit. So, you have Y, the same scenario, Mr. A is a KMP in X Limited and Y Limited. However, in this case, Y Limited purchases 100% production of X Limited on arm's length basis. In such a case, it must be further, looked into, and there is a possibility that X and Y Limited may be related parties, as Y Limited may be able to exercise control or significant influence over X Limited. So here, we are going for substance over form when it comes to this kind of an exclusion. Okay, next one, onto another scenario. Now, two ventures are not, related parties simply because they have shared joint control over a joint venture. So if, J Limited and a V Limited, they both have an equal partnership JV called JV Limited, then, we can't just conclude that J Limited and V Limited are related parties. So two co-venturers. Now, one more exclusion is basically for providers of finance like your banks, NBFCs, trade unions, public utilities, and government departments that do not jointly control or have significant influence over the reporting entities are, you can't just call them related parties, even though they may have like a significant impact on the operations of the entity. So, for example, there are times when, banks have nominated directors, they nominate a director onto the board of a company who's a non-executive observer seat on the board of directors. Then the bank the bank is not a related party of such XY, limited company. Onto another scenario. So there may be times where, a company has just one customer or a supplier, franchisor, distributor, or general agent, where, a significant volume of business, the business is very concentrated for such particular person, entity. Then, you can't simply say that, these two entities are related because of, such relation. So, for example, A Limited is an auto ancillary of an automobile company. It supplies all its production to the automobile company, but still, automobile company has no other interest in A Limited, only this one, transaction. Then A Limited and automobile company are not related parties, just because, they have significant volume of transaction and business between them. Okay, moving on to disclosures now. There are two types of disclosures, category 1 and category 2 disclosures. So category 1 disclosures we are looking at regardless, if there are any transactions with such related entities or no, but you need to list down these entities and the relationship of such entities with the reporting entity. So this will include the parent company or the ultimate controlling party or next most senior parent that produces the consolidated financial statements, along with how they are related to our reporting entity. Now, category 2 disclosures are basically disclosures that you make only when there are transactions with such related entities. So there are two types of disclosures over here. One is related to key managerial persons, and the other one where there are actual transactions that have been entered. Now, KMP related disclosures, one needs to disclose total compensation paid to KMPs, the short-term employee benefits, post-employee benefits, other long-term benefits, termination benefits, share-based payments. Then when you come to disclosures where there have been related party transactions during the year, details about such transactions need to be disclosed. So for example, nature of the relationship along with information about these related party transactions and outstanding balances. That includes, if there are any commitments that are made between the parties. At the minimum, we should, have information about outstanding balances, terms and conditions of any kind of, if there are any borrowings that have taken place, any kind of consideration if it's, non-cash, cash, that of the transaction, any kind of guarantees that are given, received, any provision for doubtful debts made for any kind of related parties, and any kind of expense recognized for bad or doubtful debts. So these are the kind of details that one needs to disclose when it comes to this category 2 disclosures of transactions under the IndAS. Now, if there are too many transactions, similar transactions of, similar nature may be aggregated, and displayed together, except when, there is a separate disclosure necessary for understanding the effects of a particular transaction, that needs to be disclosed in order for the readers of financial statement to get a better understanding of such a transaction. Okay, now there's an explicit exclusion for such disclosures. So now these exclusions refer to, PSU entities where, an entity, a government may be controlling, joint controlling, having influence over the reporting entity. So, or, is a fellow subsidiary of, another PSU. Now, they have the exemption of, exempting out of such kind of disclosures. Now, if an entity is opting for such kind of opting out of such this IndAS requirement, then in the minimum it must mention the name of the government, nature of relationship, the nature and amount of significant transactions, or when aggregated, if that becomes a significant chunk of transaction, or any kind of qualitative indication of the extent of such of the impact of such transactions. And it is left on the entity to use its judgment to determine the level of details that are to be disclosed for such kind of transactions with respect to the closeness of relationship, size of the transactions, terms of the transaction, etc. So when we're looking at disclosures, the disclosures need to be made in the individual financial statements of the reporting entity. And now there'll be, if there are group entities and all, you'll have, consolidated financial statement made for the entire group. In such situation, the intra-group related party transactions will get knocked off, or outstanding balances will get eliminated when the consolidated financial statement is being made. However, the standard says that if these kind of disclosures as per IndAS are in conflict with any kind of statutory requirements, for example, confidentiality when it comes for customer information and all, when it comes to in the case of banks, where RBI has certain provisions in terms of how much information that can be disclosed about the customers and things like that. So if the standard is in conflict with any kind of pre-existing provisions in statutes, then the statutes will prevail over this particular standard. Now I'm just going to run through quickly few differences between IndAS-24 and AS-18, sorry, AS-18, not IndAS-18. So the definition of relative has a wider coverage in IndAS-24, which includes, a domestic partner and the previous children of the spouse of the entity, along with dependents. Whereas earlier there was AS-18 only covered spouse, son, daughter, brother, sister, father, mother. Now, IndAS-24 has also introduced state-controlled enterprises, which includes government agencies, bodies, local, national, international, bodies of any such state-controlled enterprises. Whereas, AS-18 only included enterprises that were controlled by state or central governments. Now, related parties in case of joint ventures. Before, in AS-18, joint ventures and associates were not included in, related party definitions in the way, it has now been included in IndAS-24. So earlier, the entity was not able to determine the kind of effect a particular transaction or, bunch of transactions would have on its financial statements. Then it was allowed to not make a disclosure regarding this, but this is not allowed in IndAS. If there is a transaction with a related party, then a disclosure needs to be made. Now, KMP again, in AS-18, the KMP in the definition of related party, the accounting standard only included KMPs of the reporting entity. But over here in IndAS, we are including KMPs of the reporting entities as well as the parent of the reporting entity. Along with, if any group companies providing KMP services to any other companies in the group, then, that is another coverage by IndAS-24. There was no post-employment benefit funds becoming related parties in earlier accounting standard, but it has been introduced now in IndAS. So this is regarding consolidated financial statement preparation. So now if you don't have a ultimate parent, ultimate holding company making consolidated financial statements, then the next most senior parent. So if you have H Limited, where that is the ultimate holding company, and you have S Limited, that's the subsidiary of H Limited, and you have A Limited, that is the subsidiary of S Limited, then and if H Limited is not making the consolidated financial statements, then you have S Limited, which is the next most senior parent, which will be preparing the consolidated financial statements and including the disclosures of IndAS-24 in its financial statements. So now the compensation of KMP is also divided into different types of compensation that is made to the KMPs under IndAS-24. No such requirement was there under AS-18. Now, the kind of additional disclosure requirement for government-related entities that has been introduced in IndAS-24, where they need to include information about the government, the type of relationship, extent of the transaction, and impact. It is not such concept was not there in AS-18. So this is pretty much it.
There is just one addition. There is also, if I remember, one more. The amount or the volume of transaction in IndAS-24 is there, where in 18 it is optional. It's still there, or I just wanted to, the amount and or the volume of transaction is optional under IndAS under AS-18, whereas in 24 you have to give the amount. So I mean, it's more this thing. You can check it.
Yes. So the amount is required whenever there is a transaction that has been undertaken with a related party. You can, if there are too many transactions, you can probably aggregate too many similar type of transaction. You can probably aggregate it, but a disclosure regarding the amount of the transaction is necessary. Yes.
Yeah, you can aggregate, and let's say there are 20 entities together. Let's say become 100 rupees. Out of which with 3 entities, it is more than 10%, then only those transactions we have to give by name wise. Less than 10% together we can aggregate. So in this case, we can say total transaction 100 rupees, 3 entities where transaction is, let's say 10 each. So it's a 10%. So A, B, C, 10, and others 70, and total 100.
Also, the next parent is only when the consolidation is not in public use, correct? If I
Yes, yes.
correct. Okay.
But I think that exemption is given provided those are within India. Now in India, you are not allowed more than 2 layers of subsidiaries. So probably this could become redundant.
Yes, so I think I'm done with the presentation.
So Mr. Bala, you can take the questions.
Yeah. Now before taking questions, I mean, do you think what kind of transaction gets covered? Now there are certain common things which we all know, like sale purchase. Now sale purchase will include normal goods in which the company is dealing, or it could be a capital goods, or sale purchase of trademarks, brands, products also is possible. Another transaction are deposits with customers. Yeah, another important thing is reimbursement of expenses, like Kinjal did cover there. If you pay on behalf of parents or subsidiaries, basically it is a reimbursement. So either a subsidiary is paying on behalf of holding or holding is paying on behalf of. Sometimes it happens expenditure is incurred by one entity and then it is getting reimbursed.
Yeah,
That is
reimbursement in both the ways. It is either received or it is paid,
Yeah.
whatever it is, both
So
ways is included. Even if
so
you
even-
get a,
Participate courage.
yeah,
So reimbursement of expense is also transaction and needs to be reported. So
Similarly,
if the
import-
company has issued debentures, bonds, and that is being subscribed by the holding subsidiaries, associate, so that also will be the transaction. And then outstanding will continue as an outstanding so long as they continue to hold the debentures or bonds. Similarly, loan given is one transaction. And assuming for 2 years, it remains same. And in the third year, there is a partial repayment. So repayment also becomes a transaction. So
Yes.
similarly, if you have taken a loan and you repay the loan, so repayment of loan also will become a transaction.
similarly,
And
import, export of the raw material, export of the finished goods, all those things also will come as a transaction.
Yeah, that will come and
Yeah.
only outstanding will come.
Yeah, correct.
So if you are selling the goods and I have sold goods worth 100 rupees and he has repaid 90 rupees, then I don't have to say that 90 rupees payment of my sale
Yeah,
is a transaction. Outstanding, I'll have to show only 10.
correct.
But if it is a loan, I have given 100 rupees and he is repaying me 10 rupees, then
Yeah.
repayment of 10 becomes a transaction and outstanding will be 90. And so long as no repayment happens, outstanding every year will continue to be disclosed as 100. That's the difference between the two. So sometimes there is a preferential allotment, right issue, buyback. These are also transactions wherein normally holding company or promoter who are controlling the company, they participate. So whatever that transaction, we need to report as a transaction. Similarly, I mean, I do disclose even a dividend because obviously promoters also receive the dividend. So that also I take it as a related party transaction. But incidentally, these all doesn't get covered under maybe under the Companies Act, no, like arm's length, etc. That all. So this is the difference between AS and Companies Act, LODR, etc., etc. But under AS, this disclosure should be given.
Yeah,
Now,
when
if
we are- when
anybody
we are
has any other kind of transaction which we have missed out, if somebody can think of.
Okay, see that as we discussed so far, this accounting standards, one thing I want to submit to the participants is the related party transactions as defined under the accounting standards as well as the related parties is only for the purpose of disclosures, not for the compliances. As far as the definition of related parties under the accounting standards are concerned, no doubt it is a related party under the listing regulations, and compliances are also to be ensured. As far as the related party transactions are concerned, there are certain transactions which are not triggering under 188. So in that case, only you require to have audit committee approval and disclosures are to be ensured. However, we will discuss this when we are in our next webinar, next Saturday, that is on the material, this when we discuss about related party transactions. There are some more key terminology there with reference to RPT. Let us quickly go through that. Because in order to appreciate the nuances of the related party transactions, it is necessary to understand the scope of the provisions of law, meaning of certain items like goods, property, ordinary course of business, arm's length basis, etc. If you see the definition of goods, because if it under 188 subsection 1, sale and purchase of goods is covered as a related party transaction, and that triggers the compliances under section 188. But the goods as such has not been defined. So we have to borrow this from the Sale of Goods Act 1930, wherein it said that goods are defined as every kind of movable property other than actionable claims and money, and includes stock and shares. So stock and shares means that because shares are also now coming under the part of the goods, and actionable claims under the transfer of property includes unsecured debentures, fixed deposits, dividend, etc. That means to any debt other than the debt covered by the mortgage, such as unsecured debentures, fixed deposits, and dividends. So with this, what happens is that shares fall under the definition of goods. So any kind of purchase or sale of shares that is covered under 188 between the related parties, if it happens, that gets covered under 188. Even in case of purchase or sale of shares, only purchase or sale is covered, but not the subscription to the shares is not a related party transaction. The transmission of shares is not a related party transaction. Transfer of shares by way of a gift, because these are all not sale of shares. So only sale or purchase of shares is covered, but not the subscription, transmission, or the transfer, unless a transfer by way of gift. So one question is whether allotment of shares to a related party is a related party transaction under section 188. Answer is no, because issue and allotment of shares is not considered as a related party transaction. Only sale or purchase of shares is considered as a related party transaction. So unless until in case of subscription also, when the allotment takes place, only the shares come into existence. Only that point of time it will get the color of goods. That's why subscription to the shares is not a purchase of shares. Let us see the service. Service also is the same thing, availing or rendering of service that gets covered under 188. Service as such is not defined under the Companies Act. The nearest definition which we can infer upon is under the what's called as the central goods, that is GST.
GST Act.
But in case of GST also, what they say is the definition under the GST is only for the purpose of revenue. So we need not import directly that definition for the purpose of Companies Act. The reason being, whenever there is a definition in the Income Tax Act or a GST or any other act, you have to see the relevance of the definition also. To a large extent, those definitions are confined to those respective acts only. In this case of GST, the definition of service is more of revenue oriented, not in general as such. So to what extent you have to infer that upon, one need to take a call on that thing. Second is that providing corporate guarantee, is it a service and gets covered under the related party transaction? Providing corporate guarantee is not rendering a service as such, because whenever the parent company is giving a corporate guarantee on behalf of its subsidiary, it is not rendering any service as such. But there is a hair-thin difference. If there is a guarantee fee is being charged, that point of time, it may get a color of service. So one need to be careful whenever a guarantee commission is charged by the holding company from its subsidiary for providing that corporate guarantee, it may get a color of service, and that point of time, it triggers compliance under 188. Now, what is this office of place of profit? Because office of place of profit also is getting covered under 188. Office or place of profit means office or place of position which gives a person holding such office some pecuniary gain or advantage or benefit over and above what he is entitled for. The board should ensure that the directors who occupy the fiduciary position do not directly or indirectly derive any other benefit except in accordance with the law. That is we call it as managerial remuneration. So purpose is to prevent a director or his relative from holding any office or place of profit, carrying a total monthly remuneration beyond the prescribed limits. If it is there, obviously that 188 compliances are to be ensured. Now, explanation to section 188(1) defines the office or place of profit. A director, if he is a director holding, receives any remuneration from the company by way of remuneration over and above the remuneration what he is entitled for as a director by way of salary, fee, commission, requisites, etc. That is holding office of place of profit. Say, for example, if an executive director is there, what the executive director is entitled for? He is entitled for his pay. That is that whatever the basic pay is there, plus perquisites, plus commission. So as per the terms of service contract, whatever he is entitled for, as an executive director or a managing director or a whole-time director. So what he is entitled for is not a place or office of place of profit. Anything beyond, if he is getting it, certainly it is so. Similarly, in case of non-executive directors, what are the non-executive directors entitled for? They are entitled for a commission, they are entitled for sitting fees, and they are entitled for reimbursement of expenses. So anything other than these three things, that means if he is getting commission, sitting fees, or the reimbursement of expenses, if he gets anything beyond that, that comes under the office of place of profit. So for example, Mr. A, who is the managing director of X Limited, that XYZ Limited is engaged in the manufacturing of medicines. That pharmaceutical company is getting a software made out for its business purposes, and it has floated a tender. Several bids have come, and in that, this managing director of this particular company is also a technical expert. He is a software person, so he also has bid for that. And the quotation what was given by the managing director is, say for example, 50 lakh rupees, and the nearest quotation to that which has come is 2 crore rupees. Now, is this transaction an office of plus of profit under 188? Answer is yes. Because this managing director is getting that, suppose if he is awarded this particular contract, he is getting that 50 lakh rupees for providing that software. That is beyond what he is entitled for. So that is definitely an office of place of profit. Now, is it whether we have to comply with 188? Obviously, we have to see that under 188, there is one exemption which has been provided. If it is in the ordinary course of business and at arm's length, then that 188 exemption is available. Now, is this an ordinary course of business? Answer is yes. Why? Because the company is getting this software made for furtherance of its business, because it is for its purpose of the business only it is getting it made. So certainly it is in the ordinary course of business. Second, is it an arm's length basis? Answer is again yes, because the nearest quote what they have received was 2 crores and the quote given by MD was 50 lakh rupees. So it is certainly an arm's length basis. So you can take this exemption under 188. Now the question comes, does this require any other approvals? Certainly, because it is a related party transaction. Prior approval of the audit committee is required. Whether board approval is required? Answer is yes, as well as no also. Yes, because he is a managing director getting something over and above what he is there. Is he entitled for? Answer is yes. 197 subsection 4 permits that a managing director can get beyond whatever any director is entitled for. But that there is a separate procedure for 187.4. A board approval is required. Shareholders approval is required. And prior to this, the nomination and remuneration committee has to determine whether that particular executive director has the requisite expertise to provide that kind of services. And it has to recommend that it has to, number one, ensure that he got the professional qualifications, professional experience, and of course, whatever the remuneration it is proposed to pay, according to it is okay or not okay, then accordingly it has to recommend to the board for its approval. Considering the approval of the audit committee as well as of the NRC, the board has to also approve it subject to the final approval of the shareholders under 197.4. Now, suppose there are two subsidiaries are there. One is in UK and another one is in US. These both are subsidiaries of X Limited, and they are entering into a transaction abroad, and X Limited, which is the listed entity, is not a party to these transactions. Is this requires approval of, is it a related party transaction require the approval? Earlier it was not, but now what happens is that because of the change in the related party definition, which we have discussed last week, that because of that, certainly X Limited's audit committee has to approve these transactions, provided they are less than 10% of their standalone turnover of the subsidiary companies effective 1st April 2023, or 1,000 crores, whichever is lower. If it is so, the audit committee of X Limited has to approve this transaction. Of course, board approval is not required as such. Prior to this approval, this amendment in the listing regulations, when that overseas two subsidiaries are entering into a related party transaction, as far as the Indian company is concerned, no compliances were required as such. Now, suppose if a director is giving his own land on lease or its building on rent to the company, can a director give? Answer is yes, because there is no prohibition. Is it a related party transaction? Answer is yes, it is a related party transaction. Again, the same thing, whether 188 triggers or not, for that we have to examine. We have to see that whether is it in the ordinary course of business or arm's length. It is in the ordinary course of business because the company is taking the land or the building on rent or lease, whatever the case may be, for its business purpose. In such case, we can say certainly it is in the ordinary course of business. And only thing what we have to ensure is that rent or lease rentals, whatever they're paying, that should be an arm's length basis. So for that, there is a pricing methodology is there, which we need to ensure. We may have to take some comparison quotes, which is available in the market, and you have to ensure that neither you are paying less nor you are paying more, but you are paying whatever is required. And as per the market, this thing. So there are other things are also like that. The most important thing is ordinary course of business. So what is exactly ordinary course of business? This is a very, very important thing. Most of the times that we are taking this ordinary course of business, several companies are taking it very loosely, which is not correct. According to me, whenever you are determining anything in the ordinary course of business, various parameters are there, which we will discuss now. One has to ensure that all these parameters are satisfied. You have to also have, I always advise you have to better to have a file note before determining what is ordinary course of business. The reason being, tomorrow when we take the exemption and we are not complying with 188 and the regulator comes for inspection or investigation, God forbids, that point of time, it is the responsibility of the company to establish that it is in the ordinary course of business, and you should be able to put your arguments effectively and efficiently. So to say whether a transaction is in the ordinary course of business or not, it is a very subjective and judgmental, and it varies based on the transaction to transaction. You cannot have a uniform stitched formula for the ordinary course of business. In fact, if you remember in 2014, when Companies Act 2013 was legislated, that point of time, several professionals as well as some chambers of commerce and all, they have approached the Ministry of Corporate Affairs, requesting them to define what is ordinary course of business. At that point of time, some senior professionals were saying that it should not, ministry should not define what is ordinary course of business, because the companies will be in a better position to define or determine what is ordinary course of business than a regulator defining what is ordinary course of business. Better sense prevailed. Ministry has not got tempted to define it. They say that you define for yourself what is ordinary course of business. And if it is, you are convinced that yes, it is your ordinary course of business, and at arm's length, if you want to avail the exemption, by all means, you can avail it. But when we come for inspection or investigation, that point of time, you should be able to establish that it is in the ordinary course of business. Then only it will be available. So the Act has not defined the term ordinary course of business. The Black's Law Dictionary defines it is the normal routine in managing trade or business, whatever the activities are there. Those are normal course of business. In common parlance, we take ordinary course of business, which includes transactions which are entered into in the normal course of business pursuant to or for promoting or in furtherance of the company's business objectives. This is a very, very important thing. We have to ensure that if anything we have to say that ordinary course of business, that if it is in the furtherance of the business activities of the company, yes, we can say it is in my ordinary course of business. Any activity which is routine and in accordance with the usual customs and practices of a particular business, it can be described in the ordinary course of business. So one-off transaction, if anything it is happening, it may fall, it may not fall, but to a large extent, it should be a routine activity than to call it as an ordinary course of business. As I was mentioning earlier also, this interpretation need to be contextual. So taking into account the nature of the activity and its relevance in the overall context of the business of the company. So this is again the same thing, very subjective, judgmental, and depends upon case to case. That's why here the company secretary has to play a very vital role. Whenever the question comes that what is my ordinary course of business, he should be able to say what exactly that this thing. I will give an example to you. This normally for the purpose of easy understanding, this example, in fact, I always used to give it. We have ensured that this particular example is there in the part of as a guidance note also. Say, for example, Reliance Industries Limited. As you all know that we have the refinery at Jamnagar, Gujarat. Suppose if the company is acquiring an adjacent land, a big chunk of land, if it is acquiring from a related party. Is it a related party transaction? Answer is yes, because you are acquiring that land from a related party. So it is a related party transaction. Now you have to say, is it in the ordinary course of business? You cannot simply say yes or no, because you need more information for that particular purpose. By merely a purchasing transaction, you cannot say it is in the ordinary course of business or not. What you require for that? What is the purpose of purchasing that land? What for you are purchasing that land? Say, for example, the land what Reliance is purchasing, there is a proposal to construct some residential complexes on that particular land. Is it in the ordinary course of business? Again, the same thing, that information is not sufficient for me. What is the purpose for which that residential complexes are being coming up? That residential premises which are constructed on that particular land, for what purpose it is? Now there are, suppose if that particular residential premises are being developed to provide the staff quarters for the employees of the company who are working at the refinery. Because when you are working at the refinery, it is a township you are developing it, which is far away from the city. So obviously people who are working there, they cannot come from the city to the township. So mostly wherever this kind of industrial, what's called estates are there, they develop the townships, and within the township itself, they provide residential quarters to the employees. That is the object of this. Yes, definitely, because it is for furtherance of business. Hence, the purchase of land, construction of the residential premises on that, it is for my furtherance of business. So I can call that acquisition of land is in the ordinary course of business. Now, second, suppose I give a different color to the same transaction. I am purchasing the land from a related party. The purpose of purchasing that particular land, again, is the same thing for the purpose of constructing the residential premises, but for not providing the staff quarters. Here, what I am doing is I am coming up with a proposal. Whoever are the people, the staff who is working at the refinery, if they work for a period of 5 years, they can take that. Suppose I am providing the quarters to the, I am providing the houses to the employees. If they work for 5 years, the cost of construction is 40 lakhs, but they will get that particular flat, say 2-bedroom flat, for 35 lakh rupees. But he should work for a period of 5 years, then only he will get. Otherwise, he will not get that particular, whatever the, I mean, it depends upon that, what is the compensation he has to pay to the company and all for occupying that premises. Is it an ordinary course of business? Again, answer is yes, because why I am providing this to my employees is, it is for the purpose of retention of my employees, because townships, it is very difficult to retain the employees for longer periods, because the staying in a township these days it is okay, but earlier days it was very difficult because you are completely cut off from the world. Whereas now, because of the technological development and all those things, wherever you are, doesn't matter, because everything is there virtually on your mobile itself. So for the particular purpose, for the retention of the employees, instead of the employee stock options, I'm giving, this is also a kind of this, I'm giving the what's called as an I can say I'm laying a bait kind of thing, that the employee is also getting benefited. If he worked for a period of 5 years, he can purchase that building at the cost of the rupees 35 lakhs as against the construction cost of 40 lakh rupees. For him, the benefit is for that 5 lakh rupees. And similarly, he is getting a thing in the township. And of course, subsequently, as and when he leave it, that is going to be in his name, he want to sell it. That is all conditions, that is different thing. Is it in the ordinary course of business? Again, answer is yes, because it is for furtherance of my business activity. Third color I want to give to the same transaction. The purpose is not to provide as residential premises, not to give it to the employees the way I have proposed in the second option. Here, what I'm saying is anybody and everybody can purchase the houses, the residential premises, what I'm developing, they can purchase it. Is it in the ordinary course of business? Answer is no. Because this is not for furtherance of the business. This is a new business altogether. This is exactly a kind of a real estate business. I am purchasing the land, I am constructing the residential houses there, and I am selling it. So it is virtually altogether new business. It is not part of my ordinary course of business. This is how one has to determine that whenever you have to determine a transaction, is it in the ordinary course of business or not, you have to see that first and foremost thing is, what is the objective of the transaction? What is the purpose of the transaction? Is that purpose is for the cause of my business or for furtherance of my business? Then in such case, it is there. To a large extent, it should not be a one-off transaction, but not necessarily one-off transactions are not part of ordinary course of business. Suppose for another example, I want to give it. A pharmaceutical company is acquiring another pharmaceutical company from a related party. Is it a related party transaction? Again, answer is yes, it is a related party transaction. Is that acquisition in the ordinary course of business? Yes, it is in the ordinary course of business, because the purpose of acquisition of that pharmaceutical business is for furtherance of my business. That means for the expansion of my business. Instead of going in an organic growth, I am going for the inorganic growth. That means I am trying to acquire small companies which are engaged into this particular line of business. In such case, I can say that is an ordinary course of business. For example, a pharmaceutical company is acquiring a tire manufacturing business from a related party. Is it in the ordinary course of business? Answer is no, because it is not for furtherance of my business. It is for a diversification. It is not for expansion purpose, but it is for diversification purpose. So since it is an RPT, it is a related party transaction, gets 188 also triggered. So you have to ensure the compliances of 177, 188, regulation 23, if it is a listed company and all those things. So how to determine the ordinary course of business? There are a few parameters we can say based on the discussion what we have. Whether the activity is covered in the objects clause of memorandum. This is not the only aspect, but this is one of the aspects. By merely having this object in your objects clause does not mean it will fall in the ordinary course of business. Sometimes, even if it is not there in the memorandum, but still if you are taking up that business for furtherance of your business, still we can argue that it is in the ordinary course of business. But yes, it will certainly all these parameters, if at all they are on these lines, it will strengthen your case. You can argue your case in a better manner. So please ensure that whenever you are determining anything in the ordinary course of business, please ensure that it is covered in the objects clause of memorandum if it is not there. Second thing is, as I told you repeatedly, the activity should be in furtherance of the business. That means it should not be a transaction which is not connected to your business. It should be a transaction which is connected to your business. Whether the activity is a regular transaction or a one-off transaction, as I was mentioning, if it is a regular transaction, it is your job is slightly easier. If it is a one-off transaction, still I can prove it in the ordinary course of business. Say, for example, acquisition of business, which I have mentioned to you, acquisition of a pharmaceutical company by a pharmaceutical company, though it is a one-off transaction, still it is in the ordinary course of business. So whether the transactions are common in that particular industry, whether the revenue generated is shown as a part of business income, the financial scale of the activity with regard to the operations of the business. Suppose if your operation of business, this particular activity is doing only 1% of the entire business, it is difficult for you to prove it in the ordinary course of business. But if that 1% of your business is a huge volumes, still I can consider it as an ordinary course of business. Revenue generated by the activity and resources committed to this activity. So I am telling you once again that ordinary course of business, there is no standard formula, there is no stitched formula, there is no yardstick as such for that. It is absolutely contextual and judgmental, depending upon case to case. These are certain parameters which you have to examine it. Based on that, you have to determine, yes, it is in the ordinary course of business. Better to have a file note. That's why I told you in the beginning itself, better to have a file note so that you will be able to establish to your auditors as well as to the regulators as and when the need arises. Now question comes, who determines the ordinary course of business? Is it the company secretary who determines it? Obviously it is not. Is it the board or audit committee? Obviously, no doubt about it. It is at a macro level, the board has to decide it. But micro level work is to be done by the audit committee only. So what it can be done is the Act has not clearly laid down any test for determining whether the transaction is in the ordinary course of business or not. The audit committee may decide it, whether a particular transaction is in the ordinary course of business or not. For that, it has to follow the guidelines which are to be provided by the board in the policy for related party transactions. So as a company secretary, our responsibility is to ensure that the policy with reference to the related party transaction has to have a reference that what is an ordinary course of business, how it is to be determined. Based on those guidelines, audit committee will have to give certain kind of direction to the management that other than wherever any deviation is there, again, you have to refer the matter to the audit committee to determine it is in the ordinary course of business or not. Otherwise,
इसमें बस जैसे बैठता है उस हिसाब से बैठवा दीजिए.
Otherwise, based on the guidelines provided in the policy, the audit committee can determine that ordinary course of business. So my final conclusion of to arrive at ordinary course of business, we may conclude that any activity which is routine and in accordance with the usual customs and practices of a particular business can be described to be in the ordinary course of business. For a company, the interpretation needs to be contextual, taking into account the nature of activity, its relevance in the overall context of the company's business. This is what I told you also. So this is how an ordinary course of business is to be determined. Now, finally, let us see the arm's length transaction. One thing you have to remember is that people read that arm's length basis, which is provided under 188, they think it is arm's length price. It is not arm's length price. We said that arm's length basis. Arm's length means what? It is not only one, pricing is only a part of the transaction. There is a bundle of parameters are there in case of an arm's length transaction. Let us see that quickly. Arm's length transaction means a transaction between two related parties that is conducted as if they were unrelated so that there is no conflict of interest. In the 188 itself, the arm's length transaction is defined. So there is no ambiguity and there is no need for any kind of further interpretation. So it should be a transaction between two parties without any kind of conflict of interest. The transaction has to take place. So arm's length price shall be any method which considers the price which has been charged or paid or would have been charged or paid for the same or similar uncontrolled transaction with or between non-associated enterprises under the similar circumstances considering the relevant facts. So this is how you have to ensure, avoid the conflict of interest. The term arm's length basis means a bundle of terms and conditions, including price and not price alone in isolation and other terms and conditions. So I will give an example. There is Mr. A is a related party to the company and B is an outsider. I am selling a product. I am selling to A as well as to B also for 100 rupees only. So the same price I'm charging from both of them. and A is my related party. So can I say it is in the arm's length transaction? We cannot simply say yes or no, because the pricing is only one part. I have to see further terms and conditions of the particular transaction. What are the terms and conditions? Say, for example, I am giving a credit period of say 15 days to the outsider, and I am giving say 6 months credit period to my related party. Now, is it arm's length transaction? Answer is not, because the credit period I am favoring my related party. That's why it is not arm's length transaction. Another thing, suppose the outsider who is there, he has to give me, while placing the order, he has to give me the entire purchase consideration in advance to me. And when it got credited to my account, one week thereafter, I will deliver the material to him. As far as Mr. A, who is my related party, is concerned, he don't need to give me any advance. The moment he places the purchase order, on the same day, the delivery will take place. Is it arm's length transaction? No, answer is no. So price is not the only consideration. Credit period is not the only consideration. I have to see the advance terms also. Then question comes about the quality of the material. The quality what I am supplying to my outsider is say 95% quality, whereas the quality which I am giving to my related party is 100% quality. After sales service, suppose I am giving to the outsider say 3 months after sales service, whereas I am giving the warranty of say 3 months to the outsider, and to my related party I am giving a warranty of say 1 year. So warranty, again, there is a discrimination is there. So it is not an arm's length transaction. So like this, there may be a bundle of transactions, bundle of terms and conditions are there in a particular transaction. You have to see that at no place the related party is to be favored or an undue gain or advantage is given. If it is given, it is not an arm's length transaction. So simple way to demonstrate is to prove the conflict of interest is showing that existence of special relationship between the contracting parties has not affected the transaction. This is what is to be shown. Though it is my related party, there is absolutely no conflict of interest. Whatever the way I am dealing with an outsider, I am dealing with my related party also, then I can say it is at arm's length basis. Its critical terms such as price, quantity, quality, and other terms and conditions governing the transaction by following the industry benchmarks, past transactions entered, etc. For arriving at arm's length transaction, one may check if there are comparable products in the market. If yes, check the terms of sale and purchase, etc. of similar transactions and try obtaining quotes from other sources. Price in isolation cannot be the only criteria. Terms of sale of such as credit terms should be also be considered, as I have already explained to you. It is not mandatory to obtain a certificate from a valuer in every case, but this is dependent on the policy of the company on transactions with related parties. Do I need to have a valuation certificate? It depends upon the transaction. It depends upon the stakes involved. If there are high stakes are there, yes, you have to do it. This may be determined on any of the following methods. Burden to establish the transaction is an arm's length basis is on the company, not on the, whenever the regulator comes, you have to establish that this particular transaction is in the ordinary course of business, as I have already discussed, at arm's length basis, which we have discussed now. The methodologies and approaches for determining the arm's length transaction as such have not been prescribed in the Act or in the rules. That's why we need to borrow from here, there, and all. At the end of the day, what I need to establish is absolutely there is no question of conflict of interest. As far as the pricing is concerned, since the pricing mechanism is the nearest one which we can draw inference is from the Indian transfer pricing guidelines contained in the Income Tax Act 1961, because there also there is a question of related party concept and the pricing of the transfer pricing guidelines are there. So because those are already accepted by the government as such, so we can draw inference from there, and the same pricing mechanism we can adopt it. So these are all the 5 methods are there: comparable and controlled price method, resale price method, cost plus method, profit split method, transactional net margin, or such other methods prescribed by the board. Now, whenever these methods are whatever the methods we are doing it and all, Do I need to a third-party verification for this? Or whatever I am determining the price, the way I want to do it? Again, the same thing, there are no statutory guidelines or rules and regulations are there for this. It is entirely left it to the company to ensure that transactions which are in the order, if you feel that it is in the ordinary course of business arm's length, no need to go to the board or shareholders. But of course, if it is a listed company, no doubt about it, if it is a material related party transaction, anyway, you have to go to the shareholders. But only thing is that the material related party transaction, what it is there, if that 188 exemption is not available to you, there what happens is that 10% of the standalone turnover, you have to go to the shareholders for approval. That means rule 15 limits, whatever are there, it gets triggered. These limits are much lesser than the material related party transaction limit. That's why what happens is, even if it is a listed company, even if you are not able to take the advantage of 188, but you can take the advantage of 188 also. The approval of shareholders, what you have to take under 188 is different to that of regulation 23. Thank you very much. These are the key terminology which will form the basis for our discussion, which we will be having next week as far as the material related party transactions are concerned. Unless until we understand that what is my ordinary course of business, what is arm's length, what is service, what are the goods, what is my related party under the accounting standards, what are the disclosures required, we will not be able to appreciate the the related party transactions under the Companies Act as well as the restricting regulations. At the same point of time, we will not be ensure impeccable compliances unless until we got the fair amount of knowledge about these key aspects also. To a large extent, whenever people, when they ask me for some kind of a guidance, when I put the questions to them, most of the times people are loosely I got the feeling that people are loosely interpreting the ordinary course of business and arm's length, and it will be very difficult for them to establish when the regulator comes, and definitely they will get penalized. Another major important thing is, in case of any kind of non-compliance with section 188, it may affect the directorship of the directors because it will disqualify them. So one need to be very careful about that compliances as far as 188 is concerned. Another important thing is that when the stakes are very high, that means you have to ensure that by sometimes what happens is you are determining it is in the ordinary course of business, but there is a slightest doubt in your mind whether it is there or not there. In such cases, it is better to have a third party opinion. That means a legal opinion from a legal person or a company secretary. Better to have it on your file, as it will insulate you to some extent. It will not completely insulate you, but to a large extent it will insulate you. There is an expert who is giving you a kind of an idea about that. Similarly, as far as the pricing mechanism is also concerned, for example, in Reliance, we have this thing that to give the comfort to the what's called as to my audit committee as well as to the board, what we do always is that every transaction of ours, that at the end of the year, all the related party transactions are subject to a third party audit. That means a chartered accountant who is not my auditor, he will conduct the audit of that and he will give it. Similarly, every quarter, what we do is the CFO of the company is he gives, plus the company secretary, wherever CFO and CS have to give a compliance of that to the audit committee, that the transactions what they have been entered into are in the ordinary course of business and at arm's length as given under section 188. This certificate they will give it to the audit committee, and audit committee is in its prerogative once in a while to understand if any new transaction takes place. Audit committee always asks the CFO and CS how they have arrived at that this particular transaction is in the ordinary course of business. So this is how we used to ensure that compliances with 177, compliances with 188, compliances with regulation 23 is concerned. More as far as the compliances of related party transactions are concerned, we will discuss at the next Saturday webinar. As far as this key terminology is concerned, whatever we are discussing now, if you have any questions, we can discuss it further. Thank you very much.
Sir, with your permission, if I can ask one question.
Thank you. Yeah. Yes, Dignesh.
Yes, sir. Sir, from India's perspective, if CSR activity of the entity are done through foundation established by group, whether that trust or a foundation and trustees of that foundation will also be considered as related party from IndAS perspective, IndAS-24 perspective?
See,
Good question.
Dignesh, what I always say is that you have to see, first of all, as I told you very clearly, accounting standards and Companies Act and listing regulations, let us not mix up. Okay, let
Yes.
us see this separately because the purpose and objective are entirely different. Though in fact, when I was asking Kinjal to make this presentation, I was in two minds. People should not get confused that KMP definition under the accounting standards, it is not the same as Companies Act. Similarly, the related party transaction definition is not the same under the Companies Act.
Right.
Related party definition also not same under the Companies Act. So one has to understand that these terminology or these definitions, what are there under the accounting standards, to a large extent, they are simply for the purpose of disclosures, not for the purpose of compliances. Only at one place it is for the purpose of compliances, where it is the definition of related party, which is there under AS-18 or IndAS-24, though they will become related parties for the listed companies. If it is an unlisted company, purely accounting standards are concerned only for the purpose of disclosure and not for the purpose of compliances. Now your question is that whether the CSR is there, the trustees are there and all. You have to see for the purpose of compliances, you have to see that it is covered under 2 section 76 and all if it is an unlisted company. If it is not covered, you don't need to worry at all. Maybe, but at the same point of time that you don't need to worry as far as the compliances are concerned. But as far as your disclosures are concerned, if that trust is coming under the definition of related party under the accounting standards, it has to be that disclosures are required. Whatever the CSR transaction is there with that related party, necessary disclosures are to be given.
Okay, sir. Okay. Thanks, sir.
Sudhakar,
Yes, sir.
excellent. You have very nicely explained these two concepts.
Thank you very much, sir. Thank you
Lot
very
many
much.
things. I am personally, very delighted to add to my knowledge, definitely speaking.
Yeah.
Wonderfully, with the right example you have given. Hats up to you, sir.
Yeah,
Kind of you, Bala, sir. Kind of you.
Sir, very, very knowledgeable and very matured presentations. This shows your whole experience, into the PPTs. Thank you, sir. Thank you for being a part of us.
Thank you.
Yes, sir. So, yeah, Mr. Bala, Dipti, you wanted to say something. Dipti, you are muted. Dipti, you are muted.
Any more questions or we can close?
In fact, only one thing I want to add here is that when we were discussing the office of place of profit and ordinary course of business, lot of discussions have taken place of the subgroup for the first guidance note on related party transactions at Mehta&Mehta's office only. And that point of time, every Sunday, Sundays, we used to meet and we used to have good lunch provided by Mehta&Mehta. And the good part of it is we used to have lavish armrests because Mehtas are Gujaratis. They used to give us as much as armrests as we could take. That still I remember.
Thanks.
So Sudhakar
I'm sure you remember those days.
Yes.
So Sudhakar ji, so because of webinar, you are missing all these important things.
No, we can all have come to our house.
Yeah, good.
Okay, I think there is no question, so we can close this session today. Thanks, everyone. Nikhil, thanks for your time.
I have
Thanks
one
lot
question
for
if
it.
permitted.
Yeah, please.
Yes, please, go ahead.
See, one confusion was there regarding whether non-independent, non-executive directors, whether they are considered as a related party or not. Now, taking cue that Sudhakar sir can very well illustrate on it, Reliance is not showing non-executive directors.
I will tell you straight away, Deepak, the answer to your question is a non-executive director is a related party under section 2, subsection 77, because all directors are related parties. But under accounting standard, a non-executive director is not a related party. Okay, because there the definition is entirely different. So
Yes.
there, that transaction may not be required for the purpose of disclosures. If there is a transaction is there, you have to disclose it, but he is not a related party. So when you are giving the list of related parties, a non-executive director's name need not be given. Only the executive directors who are having a control and exercising influence, their names are to be given.
Thank you, sir.
Thank you, Deepak.
So one more question.
Yeah.
Can you
will it
just
be office place of profit if
Anam, just introduce yourself. You are from which place?
yeah, I am Annam. I'm speaking from Madurai, Tamil Nadu.
Oh, okay.
I'm a
And from which
company
company?
secretary at LS Mills Limited.
Okay, yeah, Anam.
Yes, sir. One of our directors resigned recently, and he's been made head of he's been made president of international marketing. Will it be office place of profit?
No,
He resigned as a director.
Your director has already resigned.
Yes,
A
sir.
resigned director is no more a director, so there is no question of office
Yeah,
of
that is right.
profit.
Because director is not there. Position is with a reference to the position he is occupying. If you are actually seen, person who is supposed to get for his office, if he is getting over and above than what he is not entitled to get, then only the concept of profit of office of profit comes into picture. Here, the office itself is vacated. So question does not arise at all.
Okay, thank you, sir.
One more thing. If it is
Yeah. Yes,
Yeah.
please.
Will that office of profit extend if the MD of the company is getting some kind of retainership from a subsidiary company? Because he's a qualified person, has necessary technical, professional and qualification.
Deepak, say that one thing, let me tell you, these kind of questions I never answer on webinars or on the seminars. The reason being, if I give an answer, it may be right, it may be wrong, because unless until you have full information, one should not venture into advice or receiving the advice also, because it may lead to a wrong understanding. See, because I was mentioning to you, whenever any advice is to be given or to be taken, as far as the RPT is concerned, in general, you can have a fair amount of an understanding. But if a detailed this thing is required, you need to understand it completely. By simply saying that my director is getting some money from the subsidiary company, a retainership, he is getting it. Is it a RPT or not? Is it permitted or not? You have to see not only 188, 177, you have to see 197, you have to see 178. There are so many things out there.
Got it, sir.
Thank you.
Okay. Now, can we close this today?
Dipti, you can definitely close because I have gone through the questions. Wherever some of the questions have been already answered, and even Nikhil has also answered the questions. And some of the questions which we are not taking it deliberately because these questions are pertaining to approval related questions, whether board resolution required, audit resolution required, what is the thing,
Dipti, I must say that our next webinar is going to be the acid test for everything, because that is.
So these things will be taken in the forthcoming sessions. So I think we can close. One thing I would like to register at this point of time, Kinjal has excellently prepared a very wonderful presentation.
What I was mentioning is that next week webinar is very, very important for us. That's why in fact, there we may be having a lot of questions. I request participants to come prepared so that we can have a good discussion.
Yeah.
And before I conclude, Dipti, I must say that Kinjal, though I think Kinjal, you have to confirm whether it is your maiden presentation. If it is so, I must say that it is excellent and superb. I can say that.
Wonderfully, you are prepared, Kinjal.
And we will give you more opportunities to make such presentations in future.
So she had prepared a very good presentation.
Yeah.
Yes, sir. First time, definitely not a count.
Great. Wonderful job you have done.
Thank you.
Thank you. Thanks all the panelists and Nikhil for your time, Sudhakar, Mr. Bala, all the participants for your contribution, Kinjal for your excellent presentation, and congratulations for getting such compliment on your maiden presentation. And
you have to disclose the interest. Say proudly that you are her mother here. Why you are hiding? People all participants may not be knowing. Kinjal is the daughter of Atul Bhai and Dipti Bhai.
Related party transaction disclosure.
Yes.
Accounting standards.
So Bala,
No,
now I'll speak on behalf of Kinjal. Kinjal, I mean Dipti, you have to give them 2 vati of armrest today.
Basically, see, and we both want to know, let her know by her own efforts and her own name rather than parents' name.
Absolutely.
And that's why we
doubt.
have not in. And she is quite insisting the same thing as well. Friends, thanks for your participation.
Dipti, before you close, I'll tell you one thing. 100% she will make you both proud.
Thanks a lot. Thanks a lot. Thanks a lot. This presentation will be uploaded on our YouTube channel. Please subscribe the same so that you will keep on getting, update on program alert for future program. Please keep on attending these with the programs. Of course, our RPT session is going on. So next week we are coming with another program. Please attend. Thanks everyone. Thank you.
Thanks everybody, and
Yeah,
to
thank
Kinjal
you.
also.
Thank you, Nikhil bhai. Thank you for a wonderful presence. Thank you, sir.